Luke, at the moment, the economics look pretty solid. It's hard to make the case that the US is close to a recession where the amount of unemployed is less than the amount of opening jobs. I mean, that's a labour market that looks pretty strong to me.
Yeah, the real R word is respect, and the U.S. economy is getting absolutely none of it still after all this. And I think looking at Robert Shiller, what he actually said about the potential for a recession when he was asked yesterday, it was there's a spirit of thinking it ought to come to an end soon. So like that to me is not a strategy. It's not a theory. I know it comes from behavioral finance, but just this idea that, you know, we're going to have some reflexivity with tightening financial conditions, CEOs really tamping down and the business cycle turning down. Well, if that happened, we might have seen it start to happen in December, but that's been arrested. Financial condition indexes now across the board are easier than they were when the market rout started in December. Greg?
Yeah, I think the fact of the matter is that it's impossible to forecast a recession. I think we always need to remind ourselves of that. Secondly, I think it's also important to remember that we're just growing a little above 2%, which means that we're more susceptible to shocks, right? So there's less cushion to absorb exogenous shocks, and I think that's critically important, which is why it's so difficult to forecast. And then third, around the fiscal stimulus package, it added 0.7 last year, 0.5% this year, and turning negative in 2020 in an election year. And the markets will focus very much on what's happening with the election. And if there's a sense that there's a Democratic rout, then I think the markets will really roll over.
So let's get into this because it's important. This line you've just used, we are susceptible to shocks. There's a belief amongst a lot of people that we're not, because we are insulated from the fiscal stimulus, and also structurally speaking, less dependent here in the United States on a global trade story. So there's a structural issue there. There's some stimulus in the mix as well. Why do you think we are so susceptible to shocks here in America?
Through the financial system.
Okay.
So if you think about what the Fed was all about, it's about stimulating the financial system in order to prop up growth. And so I still think the financial system leads in the U.S. And so that's why financial conditions is so important, right? That is a barometer of risk and lending and all those other types of measures.
Michael?
On the other hand, I think there's still the pillars of the financial community are fortresses now. The big banks are still riding from the reforms past 2008.
That's the good news.
And I think it's very, very important. Lending growth has been very, has never really accelerated in any significant way since 2009 there, which creates problems for growth, but at the same time, I think it reinforces the notion that facet of the system is very strong. And we have, central banks have gone center stage now, right? And that is policy that can be administered unilaterally and quickly if they want to.